Hey friends, very good morning. Welcome to FxYogi. In today's video, let's learn how leverage can quickly wipe out your account. Hopefully, you now have a better understanding of what margin is. If you don't know what margin is or think is an alternative form of butter, please read our previous lessons. Now, we want to take a harder look at leverage and show you how it regularly wipes out unsuspecting or overzealous traders. Before we begin, let the image below haunt you about the negative effects of using too much leverage and running out of margin. We have all seen or heard online Forex brokers advertising how they offer 200:1 leverage or 400:1 leverage. We just want to be clear that what they are really talking about is the maximum leverage you can trade with. Remember, this leverage ratio depends on the margin required by the broker. For example, if a 1% margin is required, you have 100:1 leverage. There is a maximum leverage and then there is your true leverage. True leverage. True leverage is the full value, also known as notional value of your position, divided by the amount of money deposited in your trading account. Let us illustrate with an example. You deposit $10,000 in your trading account. You buy one standard 100k of Euro USD at a rate of $1.0000. The full value of your position is $100,000 and your account balance is $10,000. Your true leverage is 10:1. That is $100,000 divided by $10,000. True leverage is also known as effective leverage. Let's say you buy another standard lot of Euro USD at the same price. The full amount of your position is now $200,000, but your account balance is still $10,000. Your true leverage is now 20:1. That is $200,000 divided by $10,000. You're feeling good, so you buy 3 more standard lots of Euro USD again at the same rate. The full amount of your position is now $500,000 and your account balance is still $10,000. Your true leverage is now 50:1. That is $500,000 divided by $10,000. Assume the broker requires a 1% margin. If you do the math, your account balance and equity are both $10,000. The used margin is $5,000 and the usable margin is $5,000. For one standard lot, each pip is worth $10. In order to receive a margin call, the price would have to move 100 pips. $5,000 usable margin divided by $50 per pip. This would mean the price of Euro USD would have to move from 1.0000 to 0.9900, a price change of 1%. After the margin call, your account balance would be $5,000. You lost $5,000 or 50% of your account and the price only moved 1%. Now, let's pretend you ordered coffee at a McDonald's drive-thru, then spilled your coffee on your lap while you were driving, and then proceeded to sue and win against McDonald's because your legs got burnt and you don't know the coffee was hot. To make a long story short, you deposit $100,000 in your trading account instead of $10,000. You buy just one standard lot of Euro USD at a rate of 1.0000. the full amount of your position is $100,000 and your account balance is $100,000. Your true leverage is 1:1. In this example, in order to receive a margin call, the price would have to move 9,900 pips. That is $99,000 usable margin divided by $10 per pip. This means the price of Euro USD would have to move from 1.0000 to 0.0100. This is a price change of 99% or basically 100%. Let's say you buy 19 more standard lots again at the same rate as the first trade. The full amount of your position is 2 million and your account balance is $100,000. Your true leverage is 20:1. In order to be margin called, the price would have to move 400 pips, $80,000 usable margin divided by $10 per pip into 20 lots. This means the price of Euro USD would have to move from $1.0000 to $0.9600. That is a price change of 4%. If you did get margin called and your trade exited at the margin call price, this is how your account would look like. You would have received a $80,000 loss. An $80,000 loss. You would have wiped out 80% of your account and the price only moved 4%. And you would probably look like something like this. Do you now see the effects of leverage? Leverage amplifies the movement in the relative prices of a currency pair by the factor of the leverage in your account. That's all for today. Let's catch up in the next video with more interesting content. Until then, take care. Bye-bye.